Hey everyone, welcome back to Corporate Decoder, the place where we help you understand if your favorite companies are secretly playing with a deck of cards with an extra ace up its sleeve. Today we're cracking open a new filing from MillerKnoll Inc., the furniture giants responsible for a good chunk of the office chairs and other stylish stuff that fills our workspaces and even our homes. This isn't a quarterly earnings report though, it's an 8K filing, which usually means something significant just happened. And what happened? Well, MillerKnoll just inked a cool new deal for some money. Joining us today is our resident financial guru, Alex, to break down what's really going on. Alex, thanks for having me. So, MillerKnoll has entered into a 3-year deal for up to $90 million. This is called an accounts receivable securitization facility. Now, don't let the fancy name scare you. In super simple terms, it's like they are selling off a bunch of their customers' unpaid bills, the money that people owe them for furniture they've already bought. They then use these unpaid bills as collateral to borrow money from lenders. Think of it like this. MillerKnoll has a bunch of IOUs from their customers. They bundle up a lot of these IOUs and sell them to a special company they created. Then that special company borrows money from banks using those IOUs as security. MillerKnoll gets cash now to use for whatever they need, like paying bills or investing in new designs. This $90 million facility is for general working capital, which generally means it's for day-to-day business operations. This can be a smart move for companies that need quick access to cash without having to take out a traditional loan that might have stricter terms. Alexandra, so is this like a sign of financial trouble, or is it just smart financial management? Where does the 90 million factor into their overall picture? Alex, that's a great question. To really understand this, we need to see how it fits into the bigger financial puzzle. The filing doesn't give us a peek into their actual balance sheet right now, but this type of facility is common for businesses that need to manage cash flow effectively. It's a way to unlock the value tied up in their receivables. MillerKnoll's common stock is traded on the Nasdaq Global Select Market under the ticker symbol MLKN. This means they are a public company and are required to report these kinds of financial maneuvers to the SEC. Alexandra, so this deal itself isn't a financial result, but it's a tool they are using. What are the actual terms of this tool? Alex, right, the deal has a scheduled termination date in September of 2028, so it's a fairly long-term arrangement. Borrowings under this agreement will have an interest rate tied to something called daily 1-month term so far, plus an additional margin. Basically, the interest they'll pay is based on a benchmark interest rate plus a bit extra. Right now, that extra bit is 1.075%. They'll also be paying some standard fees associated with setting up and managing this facility. IT Alexandra, and is MillerKnoll itself guaranteeing anything here? Alex, yes they are. Through something called a performance undertaking, MillerKnoll is guaranteeing the performance of their subsidiaries involved in this deal. However, and this is important, they are not guaranteeing that their customers will actually pay up. So if a customer defaults, MillerKnoll isn't on the hook for that specific customer's debt to the lenders. The agreements include standard clauses like representations, warranties, and covenants, which are just promises that both sides will do what they say they will, and standard events of default. These are really just the typical ground rules for these kinds of financial contracts. Alexandra, it sounds like a pretty standard financial arrangement then. So we've got this new facility, but what does it mean for the company's health and its future? Alex, well, without the full financial statements from this specific report, we can't see the direct impact on their cash or debt levels. However, we can infer that this provides them with more financial flexibility. Companies use these to manage seasonal cash flow needs or to fund strategic initiatives without diluting existing shareholders by issuing more stock to debt. Alexandra, so if this deal seems pretty routine, what else can we learn from this filing? Alex, the filing itself is quite brief and focuses solely on this new financing arrangement. It doesn't delve into operational results or specific financial performance metrics. For that, we would need to look at their quarterly or annual reports, Stop T, Alexandra, and are there any other noteworthy details in this specific report? Alex, it lists the exhibits, which are the actual legal documents underpinning this deal, like the credit and security agreement and the receivables sale agreement. These are the nitty-gritty legal contracts, but the summary here gives us the main takeaways to watch out. So to wrap up, what's your overall take on this news for MillerKnoll? Alex, from what we can see here, MillerKnoll is proactively managing its liquidity. This $90 million facility is a financial tool that gives them more breathing room for operational needs. It's not necessarily a sign of distress, but rather a sign of savvy financial management in a potentially dynamic economic environment. It allows them to have cash readily available without necessarily having to tap into other less flexible credit lines. Alexandra, so they are essentially using the money owed to them by their customers to get cash now. It's like pre-selling your future income. Alex, exactly. And the fact that they are using a special purpose entity, the wholly owned subsidiary, to carve out these receivables helps to keep the rest of MillerKnoll's assets separate and protected. This is a common structural feature in securitization to enhance creditworthiness for the lenders. Alexandra, interesting. So it's a way to efficiently use their assets. Any potential risks or opportunities you see arising from this? Alex, the primary risk is always interest rate fluctuations. If rates go up significantly, the cost of borrowing under this facility will increase. An opportunity is that having this readily available capital could allow them to capitalize on unexpected market opportunities such as acquiring a smaller competitor or investing heavily in a new product line without delay. It really enhances their strategic agility, Alexandra, and considering their market position as a furniture provider for offices and homes. How does this play into, say, consumer spending trends? Alex, that's looking ahead. Right now, this filing is purely about their financing. However, a company that has strong working capital is generally better positioned to weather any downturns in consumer or business spending. They can continue to operate and invest even if sales are temporarily softer. It reduces their reliance on more traditional and potentially more expensive forms of debt financing, especially if interest rates continue to climb in the broader economy. Alexandra, so to recap, MillerKnoll has secured a $90 million financing facility based on its accounts receivable. It's a move that provides them with financial flexibility and shows proactive cash management. Alex, precisely. It's a solid financial move that supports their operational needs and strategic flexibility. Alexandra, alright Alex, that was a fantastic breakdown. So what's your final verdict on this filing and MillerKnoll's current financial maneuver? Alex, my take is that this is a prudent financial step by MillerKnoll. It demonstrates financial sophistication in managing their cash flow without signaling any immediate financial distress. It's a way to ensure operational continuity and potentially fund future growth. I see it as a positive signal that they are being proactive in their financial planning. They've established a useful financial tool that bolsters their ability to respond to market dynamics. Alexandra, very insightful, so they are staying nimble. And for our viewers, what should they be keeping an eye on with MillerKnoll moving forward? Alex, definitely watch their upcoming earnings reports to see how this facility impacts their reported cash flow and debt ratios. Also keep an eye on wider economic trends that affect consumer and business spending on furniture. Companies like MillerKnoll can be sensitive to economic cycles. Alexandra, excellent. So we've decoded this filing and it seems MillerKnoll is playing it smart financially. What are your thoughts on this financing deal and what did you think about our analysis? Let us know in the comments below. If you found this video helpful, please give it a big thumbs up and make sure you subscribe to Corporate Decoder for more in-depth looks at company filings. You can also join our Discord community for exclusive discussions and early access to content. The link is in the description. Thanks for watching and we'll see you in the next video.